Folks, I am going to make a bold and crazy call, one that I frankly don't feel good about making because I know what it's going to do to first-time home buyers, but I believe it, so I like to share. And of course, if I'm wrong, I expect all of you to make fun of me. And when I'm right, I will wear my Nailed It shirt and make fun of folks that made fun of me. Only fair. But Matt, we're going to have this conversation with Matt, the mortgage guy, and it is interest rate related. How you doing, man?
I'm doing pretty good, Mike. How you doing?
I'm doing well. I want to thank you for doing all those one-off videos for my channel while I was on my trip. The feedback has been amazing. So excellent job. Thank you for that.
Yeah, it's fun. Just because you're out, sailing on a cruise ship doesn't mean that I don't want to
You mean
interact
the
with
world stops? I mean, come on. What's the deal?
Yeah, I mean, honestly, it's like I miss our great conversations. I miss interaction with the one rental at a time community, which it's cool. It's cool. Community, family, whatever you want to call it. People rooting for each other. People winning across the country.
People doing the work, holding each other accountable. Great audience. Great audience. But
and
here's my call.
They're paying attention.
Yes.
This week's the week to pay attention. There's some stuff happening.
Oh yeah, today, Wednesday the 15th. Oh my goodness. So here's my call, and we'll get into why. But I think by April 15th, we will once again be below 6% on the 30-year mortgage rate. I think Mortgage News reported it sometime in February when I was gone. We hit 5.99, then we took it all the way back up to 7.07 or 7.08. I believe we will be sub 6 before tax day, before April 15th. How's that feel? What do you think? You got any questions? Tell me what you think.
Honestly, my first reaction is a painful one, which might seem funny. Like, people know that I root for rates to go down. I root for first-time home buyers. I root for affordability. But these wild swings make it uncomfortable for buyers. Makes it uncomfortable for me and my team, to be completely honest, right? Like, because now you've got people who are in contract, who are locked in, and rates slide. And people start to think, well, if it went from 7 to 6.5 in this short of time, it might go down another 0.5% in a week. And so then it just creates uncertainty. And where I like a more steady downward trend or upward trend, the sharp peaks and valleys just make it hard.
How about a week of nothing? Would that be okay?
Right. Can we press pause and
just flat?
It's funny too, because when we were sub 6%, and for that brief moment in time, and you were calling 2023 sub 6% average, I responded to some comments where I didn't know it was going to happen. We both know that we don't have crystal balls. It goes to 7 people like, what happened? And now it's like, well, could we have a sub 6% average for 2023 as a whole? It looks a lot more possible. And the thing for me too is, if rates go down, which I think they will, and if they continue to go down, not in a straight line, but over the next 3, 6, 9 months, I already know what people are going to say. Oh, it's not because inflation started coming down. It's not because this. It's because of these black swan events. It's because banks crashed and there was.
I don't care. I was right. That's all that matters. Just because you're not smart enough to think. Yeah, but again, this is why I think it's going to happen. And there are actually 2 things that happened today that really make me feel certain. Because I would have said this yesterday, but I'm even more certain today. And I guess there's 3 things. First and foremost, this anchors on the fact that I believe the Fed is near their terminal rate. It all starts with that.
Yeah.
I have said for the better part of a year, the terminal rate will be 5%. I have never wavered. We are 1 or 2 raises from being at that number. The terminal rate getting there and staying there is everything to this story. So that's 1. Number 2, we got a PPI reading that surprised shockingly to the downside today. It was expected 5.4. It came in at 4.5. PPI, if you guys don't know, that's kind of, think of it as wholesale prices. So it typically feeds CPI. It's a leading indicator and an excellent one. And then perhaps the most important thing is we are seeing continuation of banking pain. Credit Suisse. Frankly, in my opinion, Matt, Credit Suisse is 10x worse than Silicon Valley Bank. Silicon Valley Bank was a isolated, not risk adjusted, all of that. Credit Suisse is one of the top 20 institutions intertwined in our global banking economy. If it goes down and it looks really shaky, there will be collateral damage.
Yeah.
So that one scares me. And then people run to safety. They run to bonds, they run to gold. Some people run to crypto, but you're seeing rates come down. And then lastly, well, actually, let me stop there. So that's why I feel good that CPI is coming down. And I guess the last thing to point about the banking crisis, and again, today is meaningful, is consumers are scared. Consumers are scared in the last 48 hours, the last 4 days, like they were when Lehman Brothers. I remember Lehman Brothers and the conversations I had with people in the hallways and all of that after that. They are right back there. And what does a scared consumer do? They pull back discretionary spending. My savings is not safe. I'm going to pull back. We're not going to do that trip. We're not going to buy that new thing. We're just going to sit tight. So I think Jerome Powell wins in the face of a banking crisis. Consumers pull back. Inflation comes in even faster. So that's where I'm at. That's why I think we're going to get sub 6.
Yeah. And thinking about the consumer pullback, it might be a healthy pullback, right? Like we might have had too much optimism, too much fake money injected. And now it's like, hey, you guys got to pull in the reins. If you look at like credit card balances and stuff like that, like people just weren't, right? People weren't pulling back and being responsible. So that might be a good thing. And, you know, I agree with you on the rate thing. I hope that it's smooth and steady and not super volatile.
Violent.
For a number of reasons. But to your point, I was looking at it, and this is like last week even. You could look at I don't know if you call it a heat map or projections or whatever for the Fed, right? And it looked, if you looked at it, like we had a couple more rate hikes going, and then May or June, you actually start to see like their projections come back. So that if that terminal rate ended up at 5, it was back in the 3s by the end of the year. And so with all the stuff that's happening, like I even heard this morning that some people think that they're going to do an emergency meeting and a cut. Right. Which
I've heard that.
Who knows if that happens, but whatever the case, if the pivot doesn't happen here, it's happening soon. That's going to have downward pressure on interest rates. If PPI readings and other CPI readings, like most smart people I follow, continue to go down, rates will follow. One thing that will be interesting, Mike, is you know, that relationship between the 10-year and the 30-year fixed. I had somebody explain it to me about the reason why there's such a big gap opposed to historically being 1.5% to 2% over 50-year period is because of volatility. And
it absolutely is.
Yeah, there's a correlation between vol, you know, volatility and that spread. So, you know, rates go down, there's going to be volatility, no doubt, for the next couple of months. But then as that volatility like kind of settles, there's even more.
Let's actually put some numbers on that. Can you pull up your rate sheet today? Homeowner, you know, 800 credit score, 20% down, you know, give me any caveats you want.
Yeah, you know, and even, you know, I think that using Mortgage News Daily 6.55 for today is good enough for
let's do 6.55. So again, the 10-year treasury, as I'm looking at my phone, I'll round it to the nearest decimal, is 3.46. So again, Mortgage News Daily, what was it? 6.55?
6.55, yeah.
So that's a 300 basis point move. And I've told people repeatedly, the 50-year trend is 1.8%. The reason we have a 3 is volatility. And it is my belief that banks are conservative until they know the terminal rate. As soon as the Fed pauses, as soon as the Fed hints that they will pause at the follow-on meeting, that margin collapses. Now, will we go back to the historical average of 1.8 immediately? No, but we'll go back to 2.5, 2.3, 2.2, 2. And if you take a 2%, or let's take a 2.3. You take 2.3 spread, which is 230 basis points on top of 3.45. What is that? That'd be a 5.75 mortgage. This is why I call sub 6. And that's not even being aggressive because, as you know, when we usually revert to the mean, we go past the mean. So and again, the reason I'm uneasy with this is because I talked with top agents around the country. One of them in the Seattle area told me their inventory is down 40% in 4 months active inventory. And if you spring a sub 6 on the market, bidding wars, offer review dates, all first time home buyers get hurt again.
Yeah, I agree. And that's why, like, we don't want too much demand too fast. The market can't handle it when we've already got 7, 8, 10 offers on anything that's, at or near the median. It's going to make it hard for consumers. And that's the thing too, is like, I'm all for, hey, like, affordability is an issue. We need prices to come down, or we need rates to come down, or a combination of the two, but we can't have too much too fast, or it's going to have, opposite effects on home prices. People aren't going to like that either. And so it'll be interesting to see, because I think, people always have expectations and they want more no matter how much you give them. In a lot of markets, like if you look at Sacramento from, call it May of 22, you probably have 15% reduction in price. So you've gotten some pullback in price. And then if you, put a 5 handle on a mortgage, okay, now it's starting to look a little bit better. But you can't want 15% more reduction in price and a 5% interest rate and expect there not to be mayhem in the market.
Yeah, if the rates get into 5s, like I expect in the next 30 days, again, I'm calling April 15th of 2023, just so there's a date on it. And again, we're in the spring selling season. The supply is not coming because of what I've talked about, interest rate lock-in and all of that. So I'm nervous. I'm apprehensive about what might be coming. Yeah. Any kind of closing thoughts on this about my crazy call of sub 6 in the next 30 days or 31 days, whatever it is?
No, I would just say from my perspective, because I see, a good thing with rates trickling down kind of cause fear and panic in people. I don't want people to obsess with interest rate. I want people to be aware of what rates are and how much they qualify for and what a mortgage looks like. And, I unfortunately deal with it a lot, and I feel a lot of empathy towards somebody who's so anxious that they're checking rates twice a day. Yeah. If you've got your scenario and you've done the work and you say, okay, at a 6.5%, here's what my payment's going to look like. Check in once a week. Are rates up or down? Oh, they're slightly better. They're slightly worse. Generally speaking, they're not going to move as much as they have in the last week.
Well, yeah. Generally speaking.
Right. So you could check in once a month and still be fine. But like, I see that
once a week. Let's do once a week for a little while.
Yeah. I just see that self-inflicted pain and fear that people give themselves and stress that I don't want them to have, because, if you're doing the work and you're making a good decision on neighborhood and price and your budget and whatnot, 6.6, 6.4, it's not going to make such a big difference that you need to look at the stock price every single day. Right. And that's what it's equivalent to, is somebody who's thinking about buying Tesla stock, checking in on the stock every 32 minutes.
Yeah. At the end of the day, folks, if you want to work with a professional mortgage broker, I recommend Matt, the Mortgage Guy. How would they reach out to you?
Go to greatmortgagebroker.com. Tell us where you're at, how we can help, and we'll connect you with somebody on the team who's licensed in your state and ready to roll.
There you go. Thanks, buddy.